we go. Banking is our topic for today. Excuse me, don't know where that came from. Too much pollen in the world. As before, with the stuff that we're doing here in the third part of the course, I want us to think about what are the common themes that we've seen through the semester. And so the first slide I actually need you to fill in for me, which is what are the concepts, when we talked about banking history in the past, what are the concepts that we've seen? So when we talked about banking history, we talked, I didn't look this up, so this is from memory. We talked about Naomi Lamoureux's article, did we not? Yes, about the use of kinship networks to establish banks in early industrial New England. We talked about something else in that era that I don't remember what it was. We talked about the wildcat banking, the free banking era, 1836 to 1864. Is that good? We talked about the National Bank Acts in the 1860s. We talked about bank failures in the 1920s. We talked about the establishment of the Fed in 1913. We talked a little bit about banking when we were talking about New Deal reforms. So what are common themes that we've seen more than once when we talked about banking? Somebody give me one. Hands. Yep. Ding, 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 ding. Oops, where's my pen? It's not there. Pen. All right. Asymmetric information. Definitely a theme that runs through everything we've talked about in terms of banking. The asymmetry of information between borrowers and lenders is one way that we've talked about asymmetric information, so that borrowers know much more about their creditworthiness than the lenders do, and that this makes the lenders hesitant to lend. So they can't come up with some way of either screening potential borrowers to screen out the bad borrowers and screen in the good borrowers, or some way of monitoring borrowers to make sure that the borrowers don't undertake behavior that makes default more likely, that interferes with the likelihood of a loan being extended in the first place. We also talked about asymmetric information in terms of the other way of our relationship with the bank. So the asymmetry in that regard was whether or not you and I as customers should trust the bank. That the bank knows a lot more about what kind of loans it's making. So this is the basis of the article by David Wheelock, for instance, about the 20 Kansas banks. The bank knows a lot more about the types of loans that it's making. In the absence of deposit insurance, we have an incentive to keep tabs on what kind of loans our banks are making, because in the absence of deposit insurance, when the bank fails, we're left without the balance in our account. Naomi Lamoureux touches on this by saying, you get around that by having the depositors and the providers of the initial capital money to start the bank be all connected through these kinship or other networks. And then Wheelock talked about that aspect of asymmetric information when he talked about whether or not the insured banks were more likely to take on risk and make riskier loans because there was not that monitoring by customers of the bankers. Good. Okay. Anything else that we talked about in terms of banking? Any other themes? Thelma and shoot. Tell me one more time. Rachel. Moral hazard. All right. So one piece of this asymmetric information is moral hazard. So whether or not people change their behavior subsequent to a contract being initiated. What other common themes? Sam. Okay, so we talked about liquidity, and we also talked about illiquidity versus insolvency. So liquidity, whether or not banks are able to meet the demand for withdrawals. And we talked about the distinction between liquidity, two L's, illiquidity versus insolvency. So illiquidity, whether or not banks are able to meet withdrawals, this has to do with the fact that their assets tend to be illiquid, difficult to change into cash without a whole lot of transactions costs, versus insolvent, whether or not the financial institutions have assets that have a smaller value than their liabilities, that is, that they have negative net worth. Okay, any other themes? Yep. Lender of last resort. So another thing was a lender of last resort. So do we have a system, which we've had some years and not have other years, do we have a system in place whereby there is some institution, right now it's the Fed, that acts as a lender of last resort, that will step in and help those banks that are facing illiquidity? They are solvent, their assets are worth more than their liabilities, it's just that their assets are too illiquid and they can't meet withdrawals. And so then we have a lender of last resort. So we had that with the Fed. The Fed did not always act as a lender of last resort, so that was the article by Richardson and Truist that looked at the 1930s, and some districts used their lender of last resort power and other districts did not, and it made a big difference in terms of the economic activity in those districts. Anything else you want to list? Peter? Booms and busts. I didn't talk much about it, but it's certainly there in history, that we have, historically, we have this pattern of financial booms and busts. So we had financial crises in the 1870s and the 1880s and the 1890s, 1907, and that really is the spur for creating the Federal Reserve and the Federal Reserve Act of 1913. And then we get to go, then we have, of course, I forgot the 1930s, of course, and then we go until the period I'm going to talk about, where we have had yet again a series of financial crises. Anything else? Diversification. Of what? Okay. So another theme is the move from banks which are focused on one small area and therefore one type of asset to having banks that have a more diverse set of assets in their portfolio, typically because of the ability of the banks to branch. So branch banking, remember we didn't have interstate banking until very recently. I forgot to look up the date. Sometime in this period I'm going to talk about today. But branch banking, where it could be, you could go to Albany or to Oakland or to Berkeley or to El Cerrito to go to Mechanics Bank, is one way of allowing banks to diversify their assets. Anything else? I've got one more I'm going to throw on the list. Yeah. Contagion. So, here I'm running out of space here. Let me swiggle. Here, I'll do my second column. This is really messy, but I don't want to do it. But what else is new? So column 2 is in a different color. So contagion in terms of bank runs. So the problem of contagion, which ties some of these other things together, that a particular bank facing illiquidity and the panic over that the depositors can't get their funds out of the institution, leads to other people either in the same place or in neighboring towns panicking that their banks as well are not going to be able to meet withdrawals and amplifying this illiquidity problem. Financial innovation. Thank you. That's what I wanted to add if we didn't get to it. All right. Another thing we've had, I have a short handout on that space, is financial innovation. So, for instance, when I talked about the national banks versus state banks issue coming out of the National Bank Acts. The National Bank Acts, remember, created the tax on the notes that had been issued by state banks. And those notes were important in the 1860s and the early 1870s because when a bank made a loan, the way they gave the borrower the proceeds from the loan was by giving them paper currency. And so when the federal government said, well, if you are a state as opposed to a national bank, if you're a state bank, we're going to tax those paper notes, first 2% and then 10%, as a way of basically forcing the state banks to stop issuing currency. That's a regulation that's set up to try to get bank behavior to change in a certain way. What do the banks do? The banks innovate, right? So the banks basically they find a way around the regulation. That's a real theme that I'm going to come back to today as well. That the banks find a way around the regulation. What do? They say, ooh, what if we did it this way? What if instead of giving people paper bills when they borrow, what if they just had an account with us and we increased the balance in their account and we gave them special pieces of paper that said pay to the order of and then had a line on them and then they could write in the amount and then they could sign it. What should we call them? Oh, I don't know. Why don't we call them checks? So they came up with this idea of checks, which allowed them to do what bankers want to do, which is to make loans because that's how they make profit, without incurring this big tax that had been implemented as part of the National Bank Act. Okay, so this is a good list. The financial innovation was the one that I had one in my head, but I wanted to add it, but didn't get their way at the top. Leverage? We haven't talked about it much in the class, however, right? So I talked a little bit about leverage in terms of households borrowing, but those particular, we're going to come up on it today. So, yeah. In what sense? Yeah. So we could get into some specifics about borrowing and what makes people want to borrow and not borrow. That's where we're going. So I think in terms of the concepts that we use to talk about the institution of banking, I think we've got a pretty good list here. So we're going to move forward. Can I move forward? Go ahead, please. Okay, cool. All right. So let's make sure we got a little bit of basics down. We use T accounts to think about the assets versus the liabilities and therefore the net worth. So remember that the definition of net worth is the difference between assets and liabilities. It's an equal sign there. If the assets are more than the liabilities, the bank has positive net worth, it is solvent. If the assets are worth less than the liabilities, the bank has negative net worth, it's insolvent, or what we call bankrupt. These days, the primary assets on the balance sheet of banks and financial institutions' loans are an important asset. So the loans that they make to you, be that for a mortgage if they hold it on their books, or for a student loan if they hold it on their books, or for commercial loan if they hold it on their books, those are assets of the banks. Another asset of the bank is the reserves, the balance it has in its reserve account at the Federal Reserve. We're talking about banks. Primary liability are the deposits. So that's the balances in our checking and or savings accounts at the various financial institutions. And then there's other little things. There's things like their real property holdings, so whatever property they own, so-called property holdings. Loans is I define loans broadly, so loans would include any bonds they had, be those corporate bonds or government bonds. So those are the big ones. I don't think I've forgotten anything. The other piece, so the T accounts that look at assets and liabilities, those are taking a picture of what we call this. Well, we call it stock, but we don't mean stock like stocks and bonds. We mean stocks like stock and flow. So the value of the assets and the value of the liabilities are things that we can evaluate at any moment in time. They're photographs. You can figure out what's the value of the assets as of April 11th at end of day, and the value of the liabilities as of April 11th at the end of day. The profit that we focus on so much in Econ 1, profit, which is the difference, of course, between revenues and costs, profit is something that is earned over a time period. And so profit is, these are both what we call flow variables. They don't exist at a moment in time. They only exist over time. So you can talk about revenue per day, per week, per month, per year, but there's no revenue of a second. It's a derivative thing. So it doesn't exist in the moment, it only exists over time. The difference between revenue and cost is going to determine the profit of the bank. The quarterly profit these days has a lot to do with what's happening with the value of their stock, not stock as in stock versus flow, but here stock as in stock versus bonds. So the value, their quarterly profit has a lot to do with how the rest of the world values the company, what they think the company is worth. The revenue, the primary revenue source for the banks are the interest payments that we're making on these loans. I got to erase something to make some room. So the earnings they have on the loans is the primary source of revenue, and their primary costs. In the old days, which I'm going to talk about in just a minute, their primary costs were their labor costs and the cost of maintaining their buildings and that sort of usual operating costs that you would expect for any business. And then, as I'll talk about in a few minutes, one of the costs that got added to the business of banking was the interest that they pay on deposits. Okay. All right. Basic definitions as they come up. If you want me to clarify, we'll go back and clarify. But let's see how we do. All right. Financial institution profits, they vary a lot over time. So these are expressed as a share of GDP. The period we're going to talk about today is mostly 1970 to the present. And this chart here starts 1965. Most of the charts today start either 1960 or 1965. And this is figure 1 in your handout. So these are expressed as a percentage of the GDP, just so that we get some sort of deflation going here. And we're going to talk about today we're going to talk about the changes that happened in banking in the early 1970s. So if I had started this picture earlier, it would be pretty much like this, that banking was a pretty stable, solid, very boring business. Think of the most boring profession you know. Banking used to be way at the top. Today people think, oh, investment banking, that'd be so like woo. So commercial bankers anyway used to be way at the top of the boring business list. And then things started to change. I'm going to talk about all that. That's the whole point of today. And we can see that the changes that I will describe will show up in terms of these fluctuations in what's happening to profits of financial institutions. So we get this big dip here in the early 1980s. That's the beginning of the savings and loan crisis, or the S&L crisis, which we'll talk about. Then we get a recovery. And we get a few little dips here in the early 1990s. In 1995, they looked much bigger, but now we have more recent history to look at. We get the surge in profits leading into the current crisis. So the surge in profits from about 2000 to about 2005 or 6, and then, of course, the bust, 2008, and pretty healthy recovery since then. So that's that. We're going to tell the story. Basically, we're going to tell the story of that graph. That's what we're going to do. All right, 1970. Before 1970, banking was a boring business. It was regulated. It was predictable. It was really boring. Nobody wanted to be a banker. I mean, it's like, why would you want to be? People did because they liked golfing on Wednesdays. But there was no excitement to banking. It was very predictable. There were three sets of institutions. There were banks, there were savings and loans, also called thrifts, and there were credit unions. Each of these institutions had different types of accounts, and they focused on different types of lending, and they were regulated by different agencies, and the deposits were insured by different companies. So commercial banks, Bank of America, Wells Fargo, and then a whole bunch that no longer exist that have been absorbed by Bank of America and Wells Fargo. Those issued checking accounts or demand deposits. They focused primarily on making loans to businesses. So if you were a person who was looking for an individual loan, Bank of America is not where you would go. They did make some loans to individuals, but their primary focus was, and frankly is, lending to business. The deposits held at the Bank of America were insured and still today are insured by the FDIC, the Federal Deposit Insurance Corporation. It's one of the agencies that was started during the New Deal. Savings and loans, also called thrifts. Savings and loan. Washington Mutual was savings and loan. There was American Savings and Loan, California Savings and Loan, Berkeley Savings and Loan, Redwood Savings and Loan, Cedar Savings and Loan, Pine Savings and Loan, Oak Savings and Loan, and so on and so forth. So lots of companies all had the phrase savings and loan at the end. These companies, these savings and loan institutions, there you would go if you wanted to have a savings account. So you would have a saving passbook. Oh, I should have brought in an old saving passbook. The savings passbook was basically the same size as a passport, but instead of having your picture inside, it would have little places where they would write down what the deposits were and what the withdrawals were. And you'd have the same passbook for a very long time because you didn't make a whole lot of transactions. So this was not the place where you made daily transactions. You would go in very periodically, maybe once a month or so, and make a deposit, and then even less periodically you would make withdrawals. So savings passbook accounts. The primary loan that was made by savings and loan were home mortgages. So if you wanted to get a home loan, that was the type of institution you were likely to go to. You were less likely to go to Bank of America and much more likely to go to Washington Mutual Savings and Loan. And the deposit insurance came through a different organization. It was called the FSLIC, the Federal Savings and Loan Insurance Corporation, also set up by the federal government, also set up in the 1930s. It's just a separate institution. They were regulated by different organizations. They were not regulated by the Fed. They were regulated by a different group. They have different agencies they responded to. And then there are credit unions. So we have credit unions still today. Credit unions, there's one for students. I forget what it's called. Let's call it the Cal Bears Credit Union. That's pretty good. A credit union is called a union because there has to be some sort of membership affiliation. Well, at least there used to be until the rules were changed about 10 years ago. There had to be some sort of membership affiliation that made it sensible for you to be a part of that credit union. So the Cal Bears Credit Union, or whatever it's actually called, you had to be a student or an alumnus of Cal to have an account with the Cal Bears Credit Union. There is a credit union, and I forget the name of it, that is for people who work for the state. Most of the church denominations have credit unions. So there's the American Baptist Credit Union. If you're a member of American Baptist Church, you can have an account with the credit union. I was at UMass. There was a UMass 5 College Credit Union. So credit unions are relatively small institutions. There's some sort of membership affiliation. So that addresses some of those asymmetric information issues because there is a second connection besides just being customers of the same bank. There's another connection that binds the people together. They're all in the same union. They're all in the same church. They all work in the same place. They're all students in the same school. That binds them together. And the credit unions did not make home loans. They made small loans. So if you wanted to borrow $1,000 to do some work on your house, you could get a home improvement loan of $1,000 or $5,000. If you wanted to borrow some money to buy a used car, you could go to the credit union to borrow money to buy a car. So they made relatively small loans. The deposits there were insured by the National Credit Union Association, another organization set up by the federal government to insure deposits. They were regulated by a different group than regulated commercial banks. So we had this three-segment structure for banking, circa, say, 1970. Bankers' hours, 10 a.m. to 3 p.m. Banks opened at 10 in the morning and they closed at 3 o'clock in the afternoon. On Fridays, they would be open until 6. So it was 10 to 3. That was it. There were no ATM machines. There was no internet. So if you wanted to get money out of your bank, you had to get to your bank between 10 and 3 Monday through Thursday or 10 and 6 on Friday. And that was the only way to get cash out of the bank. So there's a lot more checks, right? It was less. They talk about now being a cashless society, but back then it was a less cash-based society because you used checks to buy everything. So if you went to the department store, you went someplace to buy any shopping that you did, you wrote a check and you paid with a check. And everybody at that time accepted checks. No interest was paid on checking deposits. So the balance you had in your checking account at the Bank of America, no interest was paid on that. That's an outgrowth of the Banking Act of 1933 because of the belief that one of the things that got banks into trouble in the 1920s was that they were competing with each other by paying interest on the deposits. Interest could be paid on savings accounts, but the amount that was paid was regulated. So there was a limit to how high of an interest rate. It was not the market did not set these things. There was a regulation that said financial savings and loans can pay no more than, let's say, 3% or 3.5% or 5%, depending on what year it is, interest on deposits. And so everybody, didn't really matter where you banked, you were going to get the same interest rate on your deposits. So no matter which commercial bank you were at, you got a 0% payout. No matter which savings and loan you banked at, you got exactly the same interest rate. There was no competition for customers based on price. Lending activity was heavily regulated, so who could make mortgages, what kinds of loans banks could make, all of this stuff was very heavily regulated. And the types of assets beyond loans that the banks could own was also very heavily regulated. So the banks could not go off and build some apartment building and own some commercial property and try to make earnings on that. Baruch, you had a question? Why the difference in the treatment of checking versus savings? The notion is that the checking accounts are primarily the purview of businesses who are going to have large balances in those accounts because they use those accounts to make payroll. And the banks in the 20s, the belief was they had gotten into trouble by competing with each other by offering higher and higher rates of interest on these accounts. So that's it. No interest is going to be paid on these accounts. At the same time, there's a public policy desire to encourage families to save, and so you want to have some rate of return greater than 0. And so the encouragement is to save through these savings accounts and not through a checking account. The joke was that banking was a 3-6-3 business. That banks would obtain money at 3%, so they would borrow at 3%, they would lend it out at 6%, and they'd hit the golf course at 3 in the afternoon. So banking was a 3-6-3 business. That was the joke that people made. And then a bunch of changes happened. So there's a series of things. We're going to walk through these things that lead to the changes in banking. There's a change in the cost of banking. There are changes in technological developments. There's changes in regulation. All this is coming. That's just sort of a preview of the next 8 slides. And the underlying impetus for all of this is the rise of interest rates. So interest rates begin to rise in the late 1960s as the Fed is beginning to try to fight inflation. So really brief macro story. United States had pretty stable employment and pretty stable prices, 1950 to 1965. The federal government was running a balanced budget. The economy was chugging along pretty close to full employment. The United States wanted to get more heavily involved in the war in Vietnam. It was an unpopular war. They didn't want to have a tax bill that would pay for the war in Vietnam, and so we get more heavily involved in the war in Vietnam. We ramp up our defense expenditures without ramping up tax revenues. We start running big deficits. This is now we've increased aggregate demand beyond full employment. So the unemployment rate starts to go down lower than full employment. Not surprisingly, when your unemployment rate